A good, bright, sunshiny morning to you all. It's supposed to be a real rainy day to be in classrooms. But my name is Bernie Horn. I'm from the Sloan Masters, very famous class of 1980. And I'm here to introduce Dr. Antoinette Shore. So Professor Shore is a very busy person. She holds a PhD in economics from the University of Chicago, undergraduate degree from Germany. Research interests span from entrepreneurial finance to household finance, fintech, cryptocurrencies, and financial intermediation. She's taught a number of courses, currently teaching 15471, which is corporate finance, and 15473, which is a PhD course in advanced corporate finance, and has taught entrepreneurial finance and venture capital. While she's doing all that teaching and research, it's not gone unawarded. She won the Kauffman Prize medal for distinguished research in entrepreneurship. The Brattle Prize was the first prize for a distinguished paper in the Journal of Finance for the paper Effects of Corporate Diversification on Productivity. And hot off the press, she won the 24 TIAA Paul A. Samuelson Award for Outstanding Scholarly Writing on Lifelong Financial Security, awarded jointly with Professor Jonathan Parker from Sloan and Yang Sun from Brandeis Sloan, and a PhD graduate, for their paper on retail financial innovation and stock market dynamics, the case of target date funds, a very interesting paper. And when she's not doing all that, she has some extracurricular activities. She's co-chair of the National Bureau of Economic Research Corporate Finance Group and the executive editor of the Journal of Finance. She's also co-founded Ideas 42, a nonprofit that uses insights from behavioral economics and psychology to solve social problems. She's also co-director of the Sloan Consumer Finance Initiative with Jonathan Parker. And she joins us today to discuss how investors provide different types of financial advice to their peers. So without further ado, I'd like to introduce the Stuart C. Myers Horn Family Professor of Finance, Dr. Antoinette Shore. Let's give her a round of applause.
Thank you, Bernie, so much for the kind introduction. It's particularly a delight for me because I'm holding the Stu Myers Horn Family Professorship at Sloan, and I'm very grateful for that chair as well. But yes, it's a real delight to be with you all today, and I wanted to show you some research that we've been doing basically over a decade now to think about the market for financial advice and how it affects consumers, where it can help consumers, where we see a lot of challenges in this market, and then at the end talk a little bit about where you will see where technology is now also changing this market quite dramatically. But it's a really fun market to work on because it brings together really important issues in finance for consumers and for individual households and their welfare and their retirement savings, right? Together with innovation in technology, because a lot of things are now moving online, advice is provided algorithmically, and so testing how different type of advice is absorbed by consumers and how it is provided to consumers is really one ecosystem where we see the financial landscape changing, and in a way it's at the forefront of a lot of the new developments in consumer finance. All right, so without further ado, what I want to show you are basically two studies that we have done that bookend a lot of the work that we've been doing in financial advice. And in particular, right, I'm not, you all are an audience that is much more sophisticated than the average consumer or the average retail investor in consumer finance markets. But we know from a very large literature that's been going on for more than 20 years in finance, that actually the average household lacks financial sophistication, and if anything, is relatively poorly prepared for making financial decisions about, their 401k, portfolio allocation, how much to save, which vehicles to save in, and so on, right? So I'm sure you've read a lot of this, and you're aware of some of this as well, but you can trust me that, there's a very big literature on this. And so, of course, you can, right, we think that similar to, say, medicine or other expert markets, when there is such a big gap between what the individual consumer or investor knows and what the experts might know or what the market can provide, you have these intermediaries, in this case financial advisors, that could be helpful in solving the problems for the retail investor. The same way that, we have, doctors and PCPs to help us make choices about which experts to seek advice from, right? And what I want to show you therefore today are some of the insights that we now have about the market for financial advice. And this is just a silly way of saying, right, the average person is quite overwhelmed even having to think about finance. Now, why is this market for financial advice actually such a challenging market for the individual to navigate, but also for regulators to regulate well? Because as you will hopefully see at the end of this talk, is that in order to solve some of the problems that come from individuals having low financial literacy or behavioral biases that they are, hoping that if they invest in crypto, they will have 100,000% returns and therefore actually don't need to save anything, right? Those are some of the misperceptions we also see, right? Why is this so difficult to regulate? It's because in this market, we have distortions on the supply side and on the demand side. So what do I mean with this? When I will be talking about supply side, and I will show you this first, right? What I mean are that many financial advice companies, the way they are compensated and the way their compensation is set up, right, is that they benefit when the client pays high fees, but not necessarily when the client has very high returns, right? So there are lots of concerns in this market, of course, about conflict of interest, advisors taking advantage of their clients. But to really test how prevalent this type of if you want, conflict of interest is, we actually did an audit study that I will show you now, where we tested how exactly this conflict of interest shows up in the market. But that's not the only problem, because if you talk to financial advisors, they will often say that the one problem in this market is that you're facing clients that are poorly informed, and therefore the client doesn't know what to shop for. And when the client doesn't know what to shop for, our typical market forces don't work as well as we normally like it, right? When the clients know what computer I really want and is then able, let's say, to get the computer, and if they bought something that's bad or doesn't fit with their preferences, they will very quickly learn this, and the next time around, buy a better computer or a better tomato or a better, right, anything like that. But in expert markets, especially finance, where sometimes it takes 40 years to know if your advisor gave you the right portfolio allocation or not, right? It's too late. By the time you learned that you were duped, shopping then doesn't help anymore, right? And so this is really one of the core issues in finance, is that the feedback from your choices takes a long time for consumers to realize. And it can be even worse, right? It's not just time. Some consumers, I'm sure you've all experienced situations like this, but of course sometimes consumers don't even know how to evaluate success. They don't know what to benchmark against, what risk-adjusted benchmark to take, right? Sometimes people think when you tell them, oh, this portfolio had 9% return, they think, oh, this is so low because 9 out of 100%. It's like, what? It's just people sometimes don't have a concept, right? How to benchmark things. And then, right, what I'm saying is that in that type of world, it could be that clients who don't know what to shop for are distorting what the advice industry can actually offer as product. And maybe good advisors are being pushed out of the market by bad advisors, by the ones that are promising things that actually, are unrealistic, right? I mean, I'm sure some of you probably know John Bogle, who invented the index fund, used to actually always say that initially when he invented or tried to sell index funds at Vanguard, nobody wanted to buy them because people just didn't understand how much better a product that was. And it took a lot of advertising to then, at some point convince people. So this is the second issue, right? It's basically we need to understand how an average consumer perceives advice and whether they are looking for the quote-unquote right advice and they can identify the right advice, yeah? So those are the two sides of the market that I want to show you some research and some insights about. So let's go to the first side, which is the supply side of advice. And what we're trying to do in this study, which is now actually almost a decade old, and then people have replicated this more recently as well. This is an audit study. What we did is basically we worked with an audit firm that sends regular people as mock clients to finance companies to test the products that they're offering. And this is actually a big industry that already exists. I didn't need to invent this because this is financial service companies test the quality of the service provided by their different branches all the time. So these type of firms exist. But what we did, right, is because we didn't just want to see is the quality of the service good or not, right? We wanted to see whether do advisors take into account the type of portfolios and the type of biases that clients have about investing in the market. Do they take that into account when advising the client? Right? In a perfect world, what should happen? In a perfect world, right, you come with a silly belief that holding your company's stock is a great idea because you know your company so well. By the way, that's a very common bias that people have. And then they're overloaded, and I don't mean, Elon Musk overloaded in the firm he started, but people overloaded in a firm that they're just an employee at, right? So if you think about it, in a perfect world, an advisor should tell you, this is really bad for your Sharpe ratio. You're already so long in your firm for other reasons like your compensation and so on, right? Let's diversify. Now, actually, if you think about this, that's actually advice that typically is also in the interest of the advisor. Because by telling you that you should get out of your company's stock and maybe invest in funds, mutual funds, and other allocations, you are also then, the client is generating fees for the advisor. So there are the type of biases, right, where the advisor's interest and the client's interest are quite well aligned. And what we want to do in the study is to show, right, whether in those situations, indeed, the advisor gives the right advice and therefore improves the portfolio allocation of the customers. But that's unfortunately not the whole situation, right? There are also biases that clients can have where the interest of the advisor and the interest of the client are not aligned, but they are basically at odds with each other. And here, right, I will come back to this, right? So the first treatment that I just explained to you, is the second one is this company stock one that I explained to you. But think about a world where a client has a belief that chasing past returns is a great way to optimize returns, meaning that after you see that biotech is hot, you shift into biotech. And then once defense is hot, you shift into defense and blah, 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 right? And we know, obviously, from finance research that that's a very bad way of managing your portfolio, right? Return chasing has low returns. But very often, for retail finance clients, this is a way for the advisor to maximize fees, because the more you churn the portfolio, the more fees you generate. At least for, middle-class investors, where the advisor is often paid by trading fees and load fees and so on, right? For people that have a larger portfolio where maybe they're paid by assets under management, that's maybe a little bit different, right? But we are talking now about middle-class customers. And so what we did in this study is we basically endowed different type of these mock clients with these different portfolios and sent them into the market to test how real-world advisors react to clients with those different portfolios, yeah? And those different beliefs about the market. And look what we find. What we found here is that in the vast majority of cases, maybe you will not be surprised, right, is that the advisors push the client to change their strategy going forward. That makes sense, right? In the end, the advisor has to justify why they are there, right? They can't just say that's it. But more importantly, though, you see that the advisors typically push people into index funds, out of index funds and into actively managed funds, and basically into funds that have very high fees associated. And so we did, this is just on average, and I want to show you, kind of in these different treatment groups where people came with these different portfolios and different strategies, right? What you see here is that it's especially in situations where the person is in company stock, they're pushing them into actively managed funds. But you can say maybe that, I would argue that's still an improvement for the client, because even an actively managed fund is has a way better Sharpe ratio than that just being in your company stock, right? Oops, sorry. But what's more concerning is that especially the people that came with a portfolio of index funds that was already very well diversified and low fee, they pushed them into higher fee funds, yeah? So what's the takeaway from this? The takeaway, why I wanted to show you this as basically as the first evidence, is that it's not all bad and it's not all good, right? This is basically what we're finding is that it is true that advisors basically take advantage of the pre-existing biases that the customers have and exploit them. But in some situation, that is still helpful to the client, because if the client has biases, that are really bad for them, so to speak, but by changing the allocation, right, the Sharpe ratio increases, maybe both sides benefit. But then there are situations where the client already has a very good portfolio, and there it can really hurt the client. Yeah, go ahead.
What types of advisors are you interviewing?
I should have said.
It feels to me like this is mystery shopping from a really long time ago. If you look at the retail financial industry now, Reg BI, the fiduciary standard, I mean, the behaviors that you're describing would lead people to lose their jobs, and there's a ton of controls in place to make sure that that doesn't happen. So it doesn't foot with a lot of what those of us who are in the same industry see. So I'm just curious as to who you're looking at.
Cool. Yeah. So these good. So I should have said that, I'm using the word Oh, sorry. So he's asking, what type of financial advisors are we looking at, right? And I should say, so these are not registered investment advisors. These are brokers, right? The majority. And in fact, I didn't bring the results here. We have both types of advisors in the mix. And you can see the behavior is very different for advisors that have fiduciary standards than just brokers. So the results I showed you are much more muted for registered investment advisors that have, much higher fiduciary responsibility. Yeah.
The percentage of wealth management assets that are held by just brokers is de minimis at this point.
Has shrunk. Well, I mean, it's actually, that's not true. It's still actually it's still a big part. where you're right is if you think about, these are not 401k investments, right? These are people that are going to invest their private wealth, but not very wealthy people, right? With advisors, think about it as Bank of America or Ameritrade and these type of things. So, that's why I said people have repeated this study more recently as well, and they find very similar results. But let me show you, because I think that's where you are right that what has happened over the last maybe 10 years in particular is that the market for financial advice, of course, has become much more digitalized and much more online, right? And so a lot of the advice is now given by, via web tools, webinar, web applications, basically digital teaching. And what we wanted to do, so after we published this study, there was, we got a lot of questions from our financial advisors, as you also just saw, and lots of people basically saying, but look, this is not the full story. The story is that our hands are often tied because consumers don't know what to shop for. And retail investors are so limited in what they understand that, we have to cater to their preferences. And so when you see these outcomes that I just showed you, right, it's not a sign of misconduct or misaligned incentives by the advisors. It's a sign of bad shopping or bad priors by consumers. Yeah? And I'm not minimizing this because, of course, right, financial advice is not financial literacy. A financial advisor cannot tie somebody to a chair and say, now 5 hours of finance training and you're only going to get to leave here when you really understand it. No, right? They are having to provide that financial advice in a very competitive environment where people don't have a lot of patience for learning, kind of boring or complicated financial concepts, and where somebody else tells them, oh, I can provide you advice without any fees or with amazing returns, and the customer just doesn't know how to make sense of those, right? I mean, so it is a competitive world, and so understanding with what type of priors the customers come to their advisors and then how they update their priors is very important, yeah? So that's what the second study that I wanted to show you is about. And that's, if you think about it, is actually much harder to do because in a way we need to figure out how people think about financial markets when they come to an advisor. Then we need to test what type of advice is given, and then how does the client update after seeing the financial advice, right? Do they understand when I tell them passive is the best strategy with low fees for somebody who is not very sophisticated, right? Or, or do they all come to the market thinking that very active strategies are the best ones, and they don't understand that, given their financial sophistication, that's not a good idea, right? So those are the type of things that we are trying to test here. So how did we do this? What we did here is actually we partnered with, you see it's like a stupid joke, but I think it's actually true, right? Mark my words there, as your broker, it takes a lot of more nerve to sit tight and do nothing. That's often true, right? It's because if you think about it, finance is a really weird world. In most other situations, if your doctor works really hard for you and does a lot of things and a lot of tests, right, you think it's a good doctor because they care for you. But a financial advisor who shifts your portfolio all the time typically is not a good advisor, right? So it goes against the intuition of a typical retail customer from everything we've seen. Anyway, so what do we do here, right? What we did is we partnered with a number of Boston and Cambridge area employers so that we could access their employees and get their employees to look at financial advice that we were providing, yeah? So in other words, right, in an ideal if I had infinite budgets and I could command and control what some financial advice companies do, I would love to work with, and I've tried, trust me, with a financial advice company to basically randomize the type of advice that different customers see, and then to test how do they change their portfolio, how do they think about their advisors, right? What is the type of advice that the person or that an average person then can absorb and can update on, right? Now, the issue is, I can tell you, I've talked to everyone from DFA to Ameritrade, and they all said to me, we love to know what you find, but not on our clients. So that's why, but I'm still working on it, actually. I might be able, actually, soon to do this with a very large financial advice company. But what we did here, because we couldn't do this first, and we wanted to first show that this is actually important to understand, what we did here, as I said, is we worked with Boston, Cambridge area financial employers, not financial employers, but companies all the way from Biogen to Nordstrom. So we have, the scale of, or the distribution of very educated versus not so educated customers. And we brought them into a lab at MIT and at Harvard to see financial advice videos that we designed together with financial advisors in order to have exactly the right language, the right words, right? The same type of scripts that the market would also be using. And what we did is we designed financial advice videos that either are more what I would call textbook advice, meaning holding a passive portfolio with very low fees, versus a more active strategy of holding, kind of active sector-specific portfolios that are churning more quickly and so on. Yeah. And the idea here is that what we are trying to do is we first want to measure the priors that clients have when they come to their advisors to understand, right, how the distribution of representative American employees think about the market, right? How much of them already believe that index investing and passive strategies are better for them versus how many of them think that, by actively managing a portfolio, they can beat the index and they can beat a passive index, yeah? So what we did here, again, right, is we first elicited people's priors with a set of questions that we designed to understand their prior beliefs. I will not bore you with all the details here. This is, was very difficult to test and to do, but trust me for now that we are therefore able to see what are the prior understanding that a customer, that, a given participant in our study had. Then what we did, as I said, we have these videos that we show people and we randomize people into the different either passive videos or active videos, but because we are randomizing people into this, right? We will have customers who see videos that go along with their priors, and then others that go against their priors, right? For anyone, and so we can actually see how easy it is or difficult to show somebody advice that goes completely against their priors versus advice that is aligned with their priors, and how do people update on this, right? And then at the end, what do? We again go and we elicit people's beliefs about the market. We ask them to rate the advice video that they saw, and then at the end, we also ask them, we give them a set of portfolios to invest in, and they can choose, one of those portfolios, and they range all the way from a very, passive portfolio, fully diversified with very low fees, to a more skewed portfolio, with very active strategies, just to see whether, is their money where their mouth is. And we incentivize this by giving them a chance to win one of those, actually a portfolio with $5,000 in it, you know, kind of allocated in the way that they chose, you know, in the experiment to allocate the portfolio. All right, let me show you then what do we find. So the first thing I wanted to show you, maybe that's already in the back of your mind, is maybe what you would be finding is that the most literate and the most financially sophisticated customers already have a certain bias towards either being very passive or very active. But that actually is not at all the case. So what I'm showing you here is in blue are the people whose prior is that passive strategy is the better strategy for a retail investor. And in green, in green are the people that think that active strategy is the better one. And then on the x-axis here, 0 to 8, right, is the financial sophistication. So we elicit financial sophistication with, kind of, again, a number of questions that we ask people about financial markets, about how to compound interest. Again, trust me, for now, there's a huge machinery in retail finance of people who have tested these questions. So they are pretty good at, indeed, eliciting people's financial literacy. But what does this tell you, right? It tells you two things. It is true that the people who already think that passive strategies are better tend to be slightly more financially literate, right? There's more mass in the high literacy tail here and a bit less over here, right? But more importantly for my study is that it's not completely correlated literacy and prior beliefs, right? You can see that actually across the literacy spectrum, right, the financial literacy spectrum, you see both type of beliefs well distributed. That's important because what I will now show you is how people with different priors update about the strategies that I will be showing them, and I will be holding constant financial literacy. Yes, sir?
To clarify then, financial literacy did not include the idea that index investing is better.
Very good, right? It did not. What it did, however, include is that diversification is important, right? And Sharpe ratio is important. Now, I can tell you, though, and I'm sure those of you who are in financial advice, it is true that no financial advisors these days say diversification is stupid and you shouldn't do this, right? Even people who, even when, say, active, even funds that rely on active strategies, right, are starting from the idea that you need to be diversified, but that active rebalancing, for example, can help you beat the market, right? And there is, let me just, before I show you the results, right? So here's, what we did then is we taped these different advice videos that we showed to people with different type of advisors who acted our scripts, right? And then we could show those scripts to our participants. And this actually ties nicely into the question that was just asked. You see, in the active videos, I mean, in both videos, right? First, of course, the advisor will introduce themselves, and typically, this is true in the market too, will actually explain to people both types of strategies, active and passive strategies. And also will typically say that diversification is important. But what you then see, right, is that in the more active strategies, the advisor will emphasize more stock selection and market timing. And in the passive strategies, we'll focus more on diversification and fee minimization. And again, right, we used the type of language that we see the leading financial advice companies that they are using as well, right? And so this is how we designed this video. I will not bore you to show you the actual video, but you can probably understand from this how they were set up. And they were very similar in terms of, kind of the tone, the language, and most importantly, because we were designing them ourselves and we were working with these financial advisors who were willing to work with us, we had each of these videos actually taped by each advisor, so that when I now show you the result, I can hold constant the person, the advisor themselves, right? So that I'm not subject to some weird biases that might come from the fact that randomly, say the passive strategy was acted or, kind of taped by somebody who's just more convincing, more likable, and the other one by somebody who's not as likable, right? And therefore, then all these other, we like to call it omitted variables, right? But confounding factors are affecting my results. No, right? Because I'm doing this in an experiment, I can hold all these things constant. And then all I'm going to test is whether the type of strategy that's being presented to my participants, right? Whether one versus the other is more convincing, and also how do people react to it, yeah? So let me show you finally what the results from this are. So first, right, you can see the experiment itself is then a relatively simple 2x2 design, right? Because I have elicited people's prior beliefs, so I know who is more on the pro-passive side, meaning already believes that passive investing is a good idea, and who thinks active investing is a good idea. And then I randomize, right, whether they see the passive video or the active video in each of these subgroups. And again, what does this allow me to do? It allows me to see whether how hard is it to convince somebody who has a certain prior that a different strategy than what they're already believing in is a good idea, right? And of course, I can also see what happens when you show somebody a confirming video. Not surprisingly, right, what you will see is, of course, people like to be shown things that confirm their priors. But I can see this for people that have these different priors coming into our experiment, yeah? So look what we find, right? The first thing that we find is that in general, so the left-hand side, the first outcome variable that I want to show you is how do people rate the quality of the advice that is being given to them, yeah? Whether it's pro-passive or proactive. And so the first thing that I will show you here is that by a very wide margin, people don't like to be shown advice that goes against their prior, right? So this is basically... Of course, introspection tells you, obviously, that's true. But this is basically saying people actually 60%, they are 60% less happy being shown advice that goes against their, against their priors, or they like the, advisor almost 60% less. But the other thing that you see here is already that on average, no matter what your prior was, in this sample, a majority, in fact, almost 64% of people, before even we show them any advice, thinks that passive investing is a good idea. So this is, you can say maybe that's a very US-specific outcome, because in the US, right, where lots of people are participating in financial markets via their 401k and so on, they've heard already a lot of advice, right, and a lot of advertising and a lot of information, and therefore they have, certain priors that come from the world they live in. I believe, yes, you can hear from my accent, right, I'm from Germany. If you did the same thing in Germany, I think people actually would have much more diffuse priors, and in fact, I would even think that a lot of people would not even know what's passive, what's active, because it's a world where people just don't have to make these choices a lot, and therefore they haven't been at all exposed to these ideas about passive investing, active investing, and so on, right? So I'm not saying this is a universal truth, but it's interesting that in the US, there is already, right, a large set of customers that already believes that passive advice passive investment strategies are a good idea. Now, let me now show you two more quick things. maybe the most interesting thing is that I can, of course, now analyze how do people who had a proactive prior but were shown a passive video, how do they update, right? Then I can look at how does somebody who had a pro-passive prior and was either shown a passive video or an active video, how do they update? And look what you find, right? What you basically find here is that if you look at the last slide, which is basically the one with, has most of the control variables in it, basically what you can see, the strongest dislike comes from people who already had a pro-passive prior, but were shown an active video. So these people really dislike the advice that they were given. The people who have a proactive prior, but are shown a passive video, they also don't like it that much, but their reaction is by far not as strong. Why? Because you can see the coefficient here, right, is much smaller, and also the significance level is much lower. So they are probably already have a perception that passive is often a good idea, and now that you're telling me again that passive is a good idea, I recognize, kind of that this is a good idea. But it's important, right, here to see that it's in particular people who have pro-passive prior are very adverse to getting active advice. But now look at this. And so here, I'm now breaking out the same results for you, but for the people that have high financial literacy versus low financial literacy. And what we thought was really interesting is that all the action is on the high literate people. So it's the highly financial literate people that really dislike being shown an active video when they had a passive prior. And when they had a passive prior and are shown a passive video, they really like it, yeah? Because their confirmation also, goes into it. But you see, what's interesting here is, look at the low literacy people. There's no action here. They like the advice the same way. This is because nothing is significant here, right? And it's mostly, really not significant, right? It basically means that no matter what you show them, they kind of accept it. They don't have very strong reactions to what they are being shown. And given that, I want to have a bit of time for Q&A afterwards, I just want to tell you that you can do the same thing. Not just here, what I showed you is how they how they rank the quality of the advice. We can do the same thing here for how they update their priors after seeing the advice. Yeah? And you see the same thing here as well. You basically see that the people that have a pro-passive prior and are shown an active video, they really don't update that active is good. They really dislike this. The people that have a proactive prior and are shown a passive video actually go in the direction of passive. They are convinced by the passive advice. Yeah? And then again, what you can see here is that it's basically the high literate people, right? Again, show that, they are changing their priors, while the low literate people, right? They are only changing their priors if you show them the direction that they want to hear, while the low literate people, they are willing to be persuaded by whatever advice you give them. How do I see this here, right? Because you can see that on the low literate side, if you have a proactive prior, you show them a passive video, they go into the direction of advice. But if they had a pro-passive prior, show them active video, they also go in the direction of that advice. Same is totally not true for the high financially literate people, right? So on that, right, what does this, in conclusion, what does this show us? It basically shows us two things. Number one, there is already a set of customers in the US, or retail investors in the US, that seem to know that they know better, or they're at least somewhat sure that they have learned a lot about financial market, that when you try to sell them advice that they know is not so good for them, they will not go in this direction. right? But these are the highly literate people, the ones that already understand financial markets. The financially illiterate people seem to be persuaded by, the type of advice that is being offered to them, no matter what the advice is. Now, that's not great, right? Because if they get really bad advice, like, put everything into crypto and you never have to save again, that's probably not so good, right? But maybe the one hopeful glimmer of hope here is that it's not that it's harder to convince them about passive strategy and more textbook strategies. So this idea that there are people out there that have such crazy priors that you cannot give them good advice doesn't seem to be fully supported by our experiment at all, right? It basically is saying that if you give people advice when they don't know, they will take the advice. But it means that if you give them good advice, they will also take the good advice. So there's no barrier to giving people advice that is in their interest, right? And so that's why this is maybe not the best world we are in, because the best world would be, of course, if everybody had a lot of financial literacy and could make the very best choices, right? It does mean that well-structured financial advice can really help these clients to achieve a better portfolio allocation, and with it, hopefully, right, more savings by the time that they need their savings or they go into retirement. Yeah. All right, let me stop here. We have, I think, 3-4 minutes for questions. You'll shout at me and I will repeat the question. Yes. Yeah, go ahead.
Hi, Professor. Thank you so much. Very interesting study. My name is Luke, MBA 2020. So first of all, I wonder, you probably have the data, 3 points. First, could you dissect it a little bit more by looking at demographics by age? I like to think that all of our alumni here, regardless of age, are very open-minded. But my hypothesis would be that it would be kind of different if you look at the segmentation of age. Younger they are, they're more open to change versus the segmentation you did there. Second would be the timing. I believe you started this study in 2021. So what would be the past prior of the 5-year, 10-year returns, how that affect the study versus the other period of time? And last question is, not many people, I like to think we know the difference between fiduciary versus financial advisor.
Good.
This study is very focused on financial advisor, and I would love to know, or your insight, if study's not done, or challenge you to the study on the fiduciary, how that would differ. So summarizing the age segmentation and the timing and the fiduciary versus financial advisor.
Great questions. Let me tell you, so we do indeed dissect by characteristics. And at least in our study, we find that young and old are actually relatively similar in this population. It's not like, the old have very different priors from the young here. Yeah. Same thing actually, women versus men is quite similar in this population in terms of their market priors. Yeah. Now, the other thing, you're right, so we are doing kind of more recent, we are currently doing some studies to repeat this, to see, kind of how this is evolving over time. I can tell you, we did a study last year and the results are very similar. So people's priors don't change that quickly. And then the last thing I haven't shown, this is a very good question you're asking, right, about how important is knowing what the fiduciary responsibility of your advisor is in terms of how people update. And so there, actually what we did in this study, for example, and in the new study that we have done, we are, if you want, juxtaposing this study or overlaying it with information where the advisor either says, I'm a fiduciary advisor and my compensation is that I'm paid by asset under management, not by fees. And then in other situations, they say, I'm paid by the fees that are generating from your portfolio. And what we see there, for example, is that the average person in our sample is actually smart enough to understand that if there is a conflict of interest in terms of compensation structure between the advisor and the client, they are if you want, down-dating the advice, or in a way, they're updating less based on the advice that is given if they're worried that the advisor and the client have more of a conflict of interest. That's actually, again, very good news, because it's basically saying that the average person in our population here at least already understands what is a conflict of interest, right? And how can it distort the type of advice that you're getting, yeah? Great questions. I think there was, ma'am, a question there. We don't have time? I'm really sorry. You guys were great.